All right. So once again, good morning, everyone. So we are assembled here for CMA Part 1 revision. So in this Part 1 revision, I have most of you who are appearing for exams in September, October, and some of you are appearing for exams in January and February window of 2024. So keeping that in mind, we have asked the students as to which section should we start with and what is the section that they're feeling most difficult with. And the most common answer we got was section C. So, I thought I'll start with section C because most of the students think that is the difficult one. So you can see I'm not going to use any particular material like Miles or Hawk or Gleam or Wiley or anything like that. We are going to use a handmade notes for this. So I'll try to keep it as simple as possible. So let me just, I don't think this is the updated one. Okay, cool. All right. So I have your section C up on my screen. So kindly confirm if everyone has the same thing. Section C, performance management, cost and variance analysis. Kindly confirm on the chat section. All of you have section C visible? Yeah, good, good. Thank you. Thanks for confirming. So your section C title is performance management. I just assume that, nobody has any, what do you call it, resound or anything like that, right? Because I'm having two devices here. I just want to make sure there is no resound or anything. No? Good, 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 great. All right. So your section C is all about performance management. Now, what is performance management, sir? In your organization, you have a lot of factors that you need to consider. Profit, whether if I'm talking about numerical performance. At the beginning of the year, we have a target in mind. Let's say something like we want to make a profit of $1 million this year, or we want to make a profit of $2 million, whatever number you have in your mind. So every company has that objective inside their heads that we need to achieve this particular number. So performance management is all about making sure that the company reaches that particular target or reaches that particular number. Now, there might be hundreds of reasons why a company cannot reach their expected target. So let's say during the year, you wanted to make a profit of $1 million, but during the year, there was some factory shutdown due to whatever reasons, maybe something like COVID or maybe something like recently happening this spread or whatever may be your reason. So because of that reasons, for a particular span of time, your company's operations were on hold. So because of that, your overall profit has come down. You could not reach your expected target of 1 million. Or there could be another reason like your labor went on strike. So because of that, you could not reach your target. Or another reason, your supplier was unable to deliver the raw material to you for a couple of months. There was some kind of shortage of raw material or whatever it is. Or another reason, your management was not efficient. Your purchases were not efficient. You could not buy at the expected price, raw materials, or you could not hire labor at your expected rates. Or another one, so you are unable to sell your product at the expected price levels. You are unable to sell the quantity which you thought you would sell. So there are so many reasons why you are not able to reach your expected profit target. Or if you look at it the other way around, you wanted to make a profit of 1 million, but you actually made a profit of 1.5 million. So you would like to know why you made that extra profit, how you booked that additional profit, and how can you make sure that this extra profit continues for the future as well. So for these things, we need to analyze, we need to understand what are the factors why we are having profit or why we are not having the required level of profit. What are those individual elements, right? So that detailed level of analysis is done in the concept called as performance management. It is basically managing your performance of your organization. Okay, so that is a quick introduction about what is this section all about, performance management. Now, I also spoke to some of the students in person, and most of them said that, sir, the theory part is okay. We want more practical and more numerical revision. So that I'll try to focus in this session on more on the numerical side of your variance analysis. So now what I have on your screen first is basically the loss statement given by IMA. Your loss statement is what, sir? Learning objective statement. So IMA says that from each standard, each chapter or each topic, these are the areas which we expect from the students. Okay. So those statements, those topics are given by IMA. So I have them on the screen here. I have summarized that for your easy reference. So in the first part, your performance management has three parts. C1, which talks about cost and variance measurements. Then if I scroll down, you have C2, which is responsibility centers and reporting segments. Then we have C3, which is performance measurement. So performance measurement C3 and C2 are okay. It's not that difficult. It's technically very easy. Most of the students have problem in the C1 section when you start talking about the variances, right? So that is where our primary focus will be today. We'll start with C1, then we'll go on to C2 and C3. We'll try to discuss as much as possible. Okay. So just quickly look at the loss statement. So first we have analyze performance against operational goals using measures based on the revenue, manufacturing cost, non-manufacturing cost, profit, depending on the type of center or unit. These are again revenue centers and cost centers, which we'll talk it in the second topic. Then you also have what are the different reasons for variances within the performance monitoring system. Prepare a performance analysis by comparing actual results to the master budget, calculate favorable, unfavorable variances from the budget, provide explanations for the variances. So this is the most important point for our discussion. Okay. Just a sec, let me enable the trying to get a PDF file so that I can annotate. All right. So all right. Sorry. Yeah. So the most crucial one is this one, that the one that I'm highlighting in your loss statement. Prepare and performance analysis by comparing actual results to the master budget, calculate favorable and unfavorable variances from the budget, and provide explanations for the variances. This is the topic which we are going to pay the highest attention to, and this is the area where students find most difficulty. Then we are also going to look at this part, analyze a flexible budget on actual sales or output volume. Then we are going to focus on sales volume variances, sales price variances, flexible budget variances, comparing actual to the flexible budgets, and then investigate the flexible budget variances to find out who is the responsible person, what is the reason for that favorable or unfavorable variances. But once this is understood, this highlighted areas are understood, the rest of your chapters, rest of your topics are pretty much straightforward. Okay, mostly theoretical concepts. And again, if I come down, these areas are again slightly numerical and confusing for the students. That would be here. Yeah, sales mix variance, yield variances, and price variance, efficiency variance, spending and mix variances for service companies and others. So these are the most important and the most difficult areas in your section C that I have highlighted in your law statements. So please take a screenshot for your reference if you want. All right. So I assume all of you have your screenshots, and let's continue further. So just a quick introduction. I'll quickly navigate through the numericals, through the theoretical part so that we can focus more on the numericals. So why do companies do performance management? All that stuff we have already discussed. So the first and most important thing is we need to start setting up a budget and then compare them with the actuals. So we have a target in mind, a budget in mind, which we'll compare with the actuals. We'll find out the differences. So those differences are called variances. And these variances we will analyze to understand whether a particular element of your business is being used efficiently and effectively or not, right? So that is the purpose. So the budget or variance analysis, in short, is more useful if you understand the context of efficiency and effectiveness. So what is efficiency, sir? Efficiency is using your resources wisely, means using your available resources, capital, material, labor, everything, time, etc., etc. If you are using them properly, that is efficiency. By using these things, if you are able to reach your goals, right? If you are able to achieve your targets, if you are able to meet your objectives, then that is called effectiveness. So sometimes what happens is organizations might be doing everything efficiently, but might not be reaching their goal. See, efficient but ineffective, where cost targets are met. We are keeping everything within the cost and everything, but our desired goal is not achieved. What we wanted to do, that we were unable to do. We are doing everything okay, sir, but our end goal is not being satisfied, which is not being met. Or the other cases where you are effective, but you are inefficient, where your goals are satisfied, but the resources were used more than planned. You wanted to make a profit of 1 million. You made a profit of 1 million, but you have exhausted your machinery, you have overused your resources, capital zyada use kiya, all that stuff happened. So that is effective but not efficient. So we need to have a blend of these two where your organization is both efficient and effective. So why would there be variances? That's the next question for us. So that variances could be of different reasons. The first reason could be the fact that your assumptions were wrong. While preparing the budget, while preparing the target, you assumed things wrongly. You could not prepare the budget properly. This is a planning problem. Similarly, your execution was inefficient. You were unable to execute the plan appropriately, or there were a lot of environmental changes. The change in the environment has happened. Maybe economical inflation happened, so the prices increased, raw material cost increased, labor prices increased, all that stuff. Right? Then again, I'm trying to quickly skip through the theoretical part because most of you wanted to focus on the numerical part. Just let me know if this is fine, or do you want me to make any changes in the way of the session? It's fine? Wonderful. Okay. So next, the most important calculations here. So understand this. Let's take a small example to clearly understand what we are doing here. So we do something called as variance analysis, right? So what is variance analysis? We have a plan, which is basically nothing but our budget, right? So these budgets are usually prepared at the beginning of the period, not at the end of the period. So these budgets which we prepare are then compared with the actuals for that particular period. So when we compare the plan with the actual, we have a difference. That difference is called as variance, right? So this much I assume all of you already know. But the problem here in this variance analysis is, let's say as per my plan, okay, my material cost, my raw material cost planned, budgeted raw material cost was, let's say 500,000. Whereas the actual material cost is 600,000. Immediately, we know that there is a difference of $100,000, and this is a negative difference because we have spent more, right? This is an adverse variance, we call it as. If the variance is favorable, it is called favorable variance. If it is unfavorable, it is called unfavorable or adverse, right? So here the problem is, we know that we are supposed to spend 500,000, but we actually spent 600,000. So there is a adverse variance of 100. Okay, fine. This is good enough. But the problem is, what if the original plan, the budgeted material cost was for producing 1,000 units, whereas you actually sold 1,100 units. All right. Or let me rephrase that. Instead of 1,100, let's take 1,300 units, for example, just to get a different answer. Your original material cost budget 500,000 was for 1,000 units, but you actually in that year you did not do 1,000. You actually sold 1,300 units, which is more than what you anticipated. So obviously, when the number of units are increased, your cost also will increase. That is common sense. So if this is really negative, then my answer would be no, it's not really negative. It is just a problem with the volume that we have considered. We are comparing apples with oranges. We are comparing a budget of 1,000 units with an actual of 1,300 units. So this variance is not actually correct. That is a wrong number, right? If I think that there is a negative variance here, there is an adverse variance here of 100,000. And if I say that, the raw material has been wrongly purchased or the raw material has been wrongly used, and if I take corrective actions, if I fire the production manager or if I fire the purchase manager, that would be a wrong decision, right? So our inputs have to be correct. Now, so what do we do, sir? We need to recalculate our original plan. We need to calibrate our budget. Means this budget which we prepared at the beginning of the year was for 1,000 units. Our actuals are 1,300 units. So what we need to do, we need to re-prepare the budget for 1,300 units. So now comes the concept of static budget versus flexible budget. All right. So in this case, the static budget was what, sir? The one which was prepared at the beginning of the year, which is for 1,000 units, right? And the flexible budget is what we prepare for 1,300 units. That means, sir, why would we prepare the budget for 1,300 units? Didn't we already complete the period? After end of the period only, we knew that it was 1,300 units. Yes, beta, that is correct. But we want to find out whether we spent more than our original target or less than our original target. Are we in a favorable position or unfavorable position? I want to analyze that. So to analyze, I need to compare apples with apples, oranges with oranges. So I cannot compare 1,300 units cost with 1,000 units budget. So I need to re-prepare the budget for 1,300. Then I can compare 1,300 units ka budget versus 1,300 units ka actuals, right? So what do we do, sir? How do we do that? You know your basic cross multiplication. Sir, 500,000 was for 1,000 units, which means how much? $50 per unit. Material cost is $50 per unit, and you wanted to calculate the budget for 1300 units. So how much would this be? Either you can do cross multiplication, or $50 per unit, 50 into 1300. So 50,000 plus 1500, 15,000. So that would be, let's be sure, 60. So this is 500. Yep, this is 500, not 50. Okay, 500 into 1300. That would be 650,000. So what does this say, sir? If you are producing 1300 units, then as per our budget, your maximum amount that you can spend is 650,000. So instead of spending 600, how much did we actually spend? We spent only 600,000. So now you tell me, is it good or bad, sir? You had a spending capacity of 600,000, sorry, 650,000, but you spent only 600,000. As per your budget, you are allowed to spend 650, but you spent only 600 for 1300 units. So there it shows that actually you have a $50,000 of a favorable cost variance, not unfavorable. But your original variance calculation showed 100,000 unfavorable, which is wrong. Are you all able to follow till here? Quickly in the chat section, sir. Are you all able to follow this? Great. I'm seeing less responses. Okay. All right. Guys, be participative, ma. Okay. So now we understood that the original budget, comparing that with the actuals, will not give us the correct interpretation. So we need to revise the budgets. Those revised budgets are called as flexible budgets. Okay. So we do not compare the original static budget. Static means what, sir? Something that does not change, something that does not move. This is pre-planned. This was the original budget which we wanted to do, versus flexible budgets. Flexible budgets are what? The one that we actually were able to do. So now let's say, look at this case here. I just gave one small example. Information for the example, you can see selling price is $100 per unit. Material cost is $20 per unit. Labor cost is $15. Variable overheads are $10 and fixed overheads are $5,000. So now if I say our original budget was for 1,000 units. We initially wanted to produce 1,000 units. So the sales will be 1,000 into 100, 100,000, right? Next, material cost, 20,000. Labor cost, 15,000, 15 into 1,000 units. Variable overheads, 10 per unit into 1,000, 10,000. And fixed overheads, 5,000 directly given. I assume all of you know that fixed overheads are total, whereas variable overheads, variable costs are per unit, right? All these are variable, so they are per unit. This is fixed, so fixed will be given in total. All right. So here, this is my static budget which I originally prepared. 100 minus 20, 80, 80 minus 15, 65, 65 minus 10, 55, 55 minus 5, 50,000 is what, sir? My expected profit. This is called static budget. This is what? Static budget. All right. So scroll down. Let me show you this static budget at 1,000 units. So 20, 15, 10, 5. Total costs are 50. Selling price 100. Total profit is 50,000. So this is static budget. Now, if the same calculations, if I prepare for different levels of activities, sir, what if the units are only 900? What if we sell 950 units? What if we sell 1050 units? Then that is called flexible budgets for different levels of units. So you can see flexible for 900, flexible for 950, flexible for 1050. You can prepare for any level. But the most critical thing for you to identify here would be this one. So whenever we are talking about flexible budgets, you need to be very careful about your fixed overheads. Usually fixed overheads do not change with the number of units, right? So fixed overheads, we are continuing at 5,000 irrespective of whether you are selling 1,900, 950 or 1050 units. Fixed overheads usually remain constant. But sometimes in the question, they say that fixed overheads are 5,000 up to 1,000 units. But if the capacity crosses 1,000 units, your fixed overheads will increase by $1,000. So if such kind of information is there, here flexible units are 1050, which is above 1,000. So you'll have to add another $1,000 here. Total will become 6,000 for fixed costs. So please be very careful while preparing the flexible budgets. Sir, material cost 20 per unit. So 900 into 20, 18,000. 900 into 15, 13,500. 900 into 10, 9,000. So we know material cost is 20, labor cost is 15, variable overheads are 10 per unit. So just multiply with the levels, you will get these values. This is pretty much easy. Fixed overheads also, you usually take the same number, but if they say in the question, fixed overheads change based on the volume, then make sure you change that appropriately. Are we all okay with this? Flexible budgets. Did you all understand the flexible budgets? Right? Minda is asking to repeat fixed overheads. Now, fixed overheads may you have something called as step fixed costs. So usually fixed costs are constant. But whereas step fixed costs, how do they move? They look constant. This looks like this, a straight line. Whereas if we talk about step fixed cost, they change based on the level, right? So the step fixed cost looks something like this. Up to 500 units. Let's say if I take on the y-axis the dollar amount of fixed cost, up to 500 units, your fixed cost is this much. If the volume increases from 500 to 1,000, then your fixed cost is this value. If your volume increases to 1,500, then your fixed cost increases to this value, like this. Indra, did you understand that? Whenever the quantity increases to an extent, the fixed cost also increases. Again, between 500 and 600, it is fixed. Whether you buy 500 units, 600 units, 700, 800, 900 or 1,000, it's the same. The moment it crosses 1,000, again, fixed cost will increase. That is step fixed cost. So if in the question, if they give you step fixed costs, please be very careful to consider those things. Okay. All right. So I assume this is all clear for everyone. This is the theoretical introduction that I wanted you all to understand before we start with the variance analysis. So let me go to the variance analysis part now. I don't want to do it from the textbook. I want to explain you by using my own chart. So let's make a chart to understand the variances clearly. All okay? I'm just trying to find out if I already have the chart. It seems like I don't have it ready. Since the session was planned at a very short notice, I could not get all my resources. So let me try to. Okay. So what is the purpose why we do variance analysis? Let me just get this to. Yeah. In the meanwhile, what is the purpose why we have variance analysis? Why don't I have landscape? Step only. Oh, nice. Variance analysis, we have to compare. Okay. Sir, what do we want to compare? That is the next question. We want to compare targets with actuals or actuals with actuals. Repeating my question. Do you want to compare actuals with target or with budget, or do you want to compare actual with actual? Sir, both are wrong answers. We do not want to compare actual with budget. We do not want to compare actual with actual. We want to compare actuals with budget for actuals. This is the important point. We want to recast or we want to re-prepare the budget for the actual volume, and then we want to compare the actual numbers with the budget for actual numbers. Let's say my budget was for 1000 units, my actual is 1500. Sir, I cannot compare 1000 with 1500. So what I want to do, I want to re-prepare the budget for 1500 and compare with the actual of 1500. So this budget for actuals is called as a standard. Is that understood for everyone? The budget which is re-prepared for the actual volume is called as the standard. So in other words, a standard is nothing but flexible budget at actual volume. Is that understood for everyone? Yes? All right. Cool. Thank you. Please confirm in the chat section, guys. Please be interactive in the chat so that I can understand I'm not wasting my Saturday and I'm actually helping you guys. If you do not respond in the chat section, then I'll feel that my Saturday is wasted on these idiots. So please make sure you respond. Chalo. So now, what would be the reason why we have variances, sir? What is our ultimate goal? We wanted to make sure our budgeted profit versus actual profit. This is my end goal. Do you agree to that? My end goal is to understand what is our budgeted profit and what is our actual profit and what are the reasons for the differences. This is our actual goal, end goal. So now let's understand why we would have this kind of differences. So the first reason why we would have these differences is, okay, one, because of costs, two, because of sales. I'm trying to keep it very easy for you all to understand. So please let me know if in case you have any doubt at any point of time. Because variances, what happens is it goes in a flow. If the flow is disturbed somewhere or if you miss the track somewhere, there after that point you will not understand anything. So you have the raise hand option. So if in case you have anything to say me, please raise your hand. I'll pause the session accordingly. Please make sure you let me know whenever you have any problem. Okay. Chalo. So the variance in the budgeted profit and actual profit, that could be because of two reasons. One is there is a difference in the cost, and the other reason is there is a difference in the sales. So if I talk about differences in the cost, so what are the costs that we have? If I generalize that, we have four costs, right? What are the four costs? We have, quickly, chat section, what are the four costs that we have? Yes, material, labor. Very good. Overheads. Again, within overheads, we have two types of overheads. What are the two types of overheads? Variable overheads and fixed overheads. Very good. Wonderful. So we have all these things: material, material, labor, variable overheads, and fixed overheads. These are the four costs that we have. And again, in sales, you could be having two reasons for the differences now. The first reason is you could be having sales price variance. You wanted to sell each unit for $15, but you were only able to sell it for $13. So $2 per unit, you were unable to sell at the expected price. So because of that, your profit is lower by $2 per unit. So sales price could be different, and sales volume, you were unable to sell as much as you wanted to. You wanted to sell 10,000, or you sold only 8,000, or you sold 15,000, whatever it is. Now, this sales volume variance is nothing but, this sales volume variance is nothing but your static budget versus the flexible budget variance. So static budget is what? Budget prepared for original quantity, budget prepared for budgeted quantity. Your flexible budget is the standard that is prepared for actual quantity. So this difference between static budget and standard. Static budget is for budgeted quantity, standard is for actual quantity. So this is the quantity difference that you are talking about. That quantity difference is the sales volume variance. So I can say this is the static versus flexible. Are we clear with this till now? Right? Okay, great. Now, moving on. Excellent, excellent. So let's start with the material, sir. Now, before I even start with material, labor and all, let me ask you one thing. Why are we doing this entire analysis of budgeted profits versus actual profit? So we are doing this to know what went right, what went wrong, correct? Where is DND? Do you guys can see that somewhere? You can't see DND. Yeah, here it is. Okay. So we prepare this variance analysis to find out what exactly is the reason, what is the root cause of the reason for the variances, right? So the root cause reason for variance could be, it could be material, it could be labor, it could be variable overheads, it could be fixed overheads, it could be sales price, it could be sales volume. This is at the top level to understand what went right, what went wrong. At the summary level, if I want to go a little bit into the depth of it, if I want to go a little detailed into it, within material, the difference could be because of two reasons. What are the two reasons, sir? One is material has been purchased at a higher rate, right? Material has been purchased at a higher price or higher rate. And the other one is you have used more raw material than anticipated. You wanted to use 5,000 kgs of raw material, but you used 8,000 kgs of material. So the usage has been more. Do you all understand this? So let me tell you very clearly, if I explain one variance in proper manner, the rest of the variances are all understood automatically. So if the first material variances is clear, you will understand all other variances in 10 minutes. So I'll take as much time as required for material variances. So pay 100% attention here. All of you understood the bifurcation of material variance into rate and usage? Yes or no? Yep. All right. Okay. So material, there could be there could be a reason that you purchased at a different rate or you used more than the expected quantity. Sir, why are we doing it like this? To understand this. Sir, rate variance is responsibility of which person? Who is responsible for the purchase price of the raw material? Purchase department, purchase manager, right? So purchasing department is responsible for the material rate variance, whereas usage is depending upon the production manager, correct? Correct. Production department. So your rate variances are purchase department's issue, whereas usage depends upon the production department. So now keep this in mind. I want to expand on the material, only the material part, sir. Why? Because the rest of the topics automatically follow whatever we discuss in material, the same concept will be automatically followed there as well. Okay. So let's start with this material cost variance. So how do we calculate the material cost variance, sir? Actual, however you want to take it, I'll take standard cost versus actual cost. Did someone say something? Or am I hearing things? I'm alone at my home and I don't want to hear things here. Did someone say something or I just heard something? Yo, don't scare me. I'm alone at home. Chalo. So in case of material cost variances, standard cost versus actual cost is what we do, right? Sorry, just wanted to make sure that it's appropriate. So material cost variance, standard cost versus actual cost. Now, how do we calculate the standard cost? Standard cost is calculated as standard quantity of raw material multiplied by standard rate of raw material, correct? Standard quantity of raw material into standard rate of raw material. Do you all agree with this or not, sir? Yep. All right. Versus means minus. Actual cost. How do I get actual cost of material? Actual quantity into actual rate. Okay. So this is also clear. Now comes the next point. That is, this only if I write in short form, this will be SQ into SR, standard quantity into standard rate, minus AQ into AR. All right, this is clear. So now our next step is to split this into two levels. What are the two levels? The two reasons for material variance would be: one, material price variance, which is because of the purchase manager, and second one is material usage variance, which is of the production department. Okay, so now price variance, material price or material rate variance. Sir, price is also called as material rate variance or material price variance. It's okay, not a big deal. Don't worry about the terminology as such. Now, this rate variance or price variance, we very clearly know this is the difference between the standard, what did you call it, rate here now? Okay. standard rate minus actual rate. Is that okay for everyone? Material rate variance or material price variance, I guess it's more appropriate to call it rate. Labor may we call it rate. For labor we call it rate. For price we usually, for material we usually call it price. So I'll just replace this with price here. AP into SP. It's okay. It's okay to call it rate. There is no problem. Absolutely no problem. I'm just being whatever. Okay, so you tell me quickly, sir. Is this fine? Standard price minus actual price or standard rate minus actual rate? Now the question is, sir, this will give me per unit. Standard price per unit or standard rate per unit we get. We want the total. We don't want per unit. We want total. So we need to multiply this with the number of units. So into quantity, I have to do that much is clear. The problem is which quantity. Should I take standard quantity or should I take actual quantity? That is the question. So for that, we need to understand which department is responsible or who is the responsible person here. Here, purchase manager is responsible for the material price variance, right? So purchase manager does not know what is the standard quantity of raw material that they are supposed to use. Purchase manager only knows that production department asked me to buy 10,000 kgs. So I bought 10,000 kgs. Whether they are supposed to use 5,000 kgs, 8,000 kgs, 10,000 kgs, 20,000 kgs, that is their problem. Purchase manager does not know what is the standard quantity that the production department is supposed to use. Is that understood or not, sir? Yes or no? If you did not understand this, then you will not understand any other variances. If you did not understand, please let me know. So purchase manager has nothing to do with standard quantity of material. What is standard quantity of material? How much raw material you are supposed to use? Purchase manager does not know how much quantity you are supposed to use. That will be known to only production manager. Production manager will say that, hey, purchase department, we want 5,000 kgs of raw material. So purchase department will buy whatever quantity production department has asked them. Is that clear? So purchase department will always deal with the actual quantity. They will never deal with the standard quantity. They don't even know what is the standard quantity, first of all. Only the production department will know what is the standard quantity, sir. Purchase department will buy whatever production department has asked. Tulsi, clear? Yep. All right. Now, sir, talking about the material usage variance. So we know that usage is the responsibility of the production department, right? Floor in charge, production manager, production supervisor, whatever may be the title. Every company has a different title. So let's not worry about the titles. Production department is responsible for the production usage, raw material usage. So usage variance is the difference between the standard quantity that they are supposed to use minus actual quantity that they actually used. Agree? Production department is responsible for properly using the material. So how much quantity they are supposed to use versus how much quantity they actually used. That is the usage variance. Now, in this usage variance, this will give us the quantity. Sir, this is price. This is quantity. So price into quantity, we get the amount. Here also, this is quantity. I have to multiply with the price to get the amount. Correct? So now at which price should I multiply? Should I multiply with the standard price or should I multiply with the actual price? Should we take standard price or should we take actual price? That is the question. So the answer depends upon who is responsible for that variance. Material usage variance is the responsibility of production department. Production department does not know whether the purchase department is buying for $5 or $10 or $20. They are not at all concerned with it. Right? Production manager, you are the factory in charge, you are the factory supervisor. You get the material from the purchase department. You don't know whether they bought it for $5 or $8 or $10. You don't know the actual price and you are not even responsible for that. Your responsibility is only for the quantity. So we take the standard price. I assume this is all clear for everyone. If in case you have any doubt, immediately let me know. Don't wait. Please let me know if you have any doubt, ma. Did you all understand why we take standard price in material usage and actual quantity in material rate variance? That the entire complexity of variances is only in understanding whether actual should be taken or whether standard should be taken. That is the only confusion which students have. Everybody will write this usage variance, how much you are supposed to use, how much you actually used. That much everybody will do. Your confusion will be whether I should take standard or whether I should take actual. So this is the explanation for that. Right? So if you are talking about usage variance, that is production department responsibility. They do not know whether you purchased for $5 or $8 or $10. They don't know the actual and they're not worried about it. They are not responsible for it. So we only take the standard rate or standard price. Whereas purchase department does not know what is the standard quantity given for the production department. They only know whatever they asked, that much we will buy. So they only know the actual quantity of material they bought. So we only take the actual quantity for the purchase department. All right. So now comes the summary. एक बार ये हो गया तो summary. So see this. What did we do here? Standard price minus actual price into actual quantity. So if I expand this, standard price into actual quantity minus actual price into actual quantity. Correct? Next, regarding the usage, standard quantity minus actual quantity into standard price. If I expand this, standard quantity into standard price minus actual quantity into standard price. So look at this. If I add these two, plus SP into AQ minus AQ into SP, these two will get cancelled off. So ultimately we will have what? We will have standard quantity into standard price minus actual quantity into actual price. If I just rephrase that. So look at what is material variance, sir. Standard quantity into standard price minus actual quantity into actual price. What did you get here? Standard quantity into standard price minus actual quantity into actual price. Is this clear for everyone or not? If there is anyone who has any doubt in the material cost variances, please let me know now, because in the next 5 minutes we are going to go through the remaining variances. Labor variances 5 minutes mein khatam, overhead variances 5-10 minutes mein khatam, fixed overheads small difference will be there, that's okay. If you have any doubt in the material variances, please let me know right now. Can you repeat the last point? Which last point, beta? I'll keep that on the screen. Just look at that. You should be able to understand. Or you can let me know what is the last point that you are referring to. Then I'll be able to explain that. In case anyone wants, they can take screenshots. No issues. All right. That is the total cost variance thing. So you can take a screenshot of that. I'll turn off the video so that you can just look at the chart. Please go through this once before I move on to the next topic. Are we clear? Can I continue? SQ into SP minus AQ into APR. I'm just summing up all the four leftover these things. This all four. If I add them up, so SP into AQ is plus here. यहाँ पे AQ into SP is minus. SP AQ SP AQ. So this two will be cancelled off. Remaining is SQ into SP minus AQ into AP. So yeah, clear? SQ into SP is what? Standard cost. AQ into APS, actual cost. This is what you wanted to do in the first place. You wanted to compare standard cost and actual cost. All right. So I assume this is all clear for everyone. So now is the time for magic. Okay. So the time for magic is that, how can I copy this entire thing? Create, copy, Paste. Awesome. Delete. This one. Get back to full screen. This is material cost. Okay. Now look at the story, sir. Material cost will change to labor cost variance. Okay. Oh, there is a delay here, it seems. Okay. So material cost is changed to labor cost. So labor cost is standard cost versus actual cost. And यहाँ पे quantity will be replaced by hours. Sir, why? Labor are not paid based on the material. They are not paid based on quantity. They are paid based on hours. So standard hours into standard rate per hour. How much is the rate? Minus actual hours into actual rate. Agree all of you? Standard hours into standard rate, actual hours into actual rate. So standard hours is SH, standard rate is SR. Actual hours is AH, actual rate is AR. Now, first one. In a labor, the variance will be labor rate variance. Labor are paid more than what we expected to pay, which is the responsibility of HR. Let's call it HR. Maybe whoever is responsible for hiring the labor, whoever is responsible for fixing the labor rate, hourly rate, minus material usage nahi, labor efficiency, which is again production department is only responsible for labor efficiency. So I'll leave it like that. So standard price is standard rate, actual price is actual rate, actual quantity will be actual hours, standard quantity will be standard hours, actual quantity will be actual hours, standard price will be standard rate. So yahan pe SP becomes SR, AP becomes AR, AQ becomes AH, SQ becomes SH, AQ becomes AH, SP becomes SR, SR into AH minus AR into AH, SH into SR, AH into SR. So this will be standard quantity will be standard hours, standard price will be standard rate, actual quantity will be actual hours, actual price will be actual rate. Khatam, your labor variances are done. Sir, there we called it material usage. Here we call it as labor efficiency. Material usage and labor efficiency. That's the only difference. बाकी सब ठीक, बाकी सब सेम. वहां पे क्वांटिटी, यहाँ पे आवर्स, वहां पे प्राइस, यहाँ पे रेट. Remaining story is almost all same. Please take screenshot or note it down. Let me get my phone. Varsha asked if, sir, in labor hours, the rate means hourly rate, ma. Hourly rate per labor. I don't see what you are talking about, ma. It is SR only, not SP. Let me zoom in. Labor efficiency, standard hours minus actual hours into standard rate. Standard hours minus actual hours into standard rate. SR, SR, SR. I don't know where you are seeing SP. It is standard rate only. Okay, acha, your question is why are we taking SR and not AR? Why are we taking standard rate, not actual rate? Is that your question? All right. So understand this. Efficiency has nothing to do with at what rate you are paying them. Efficiency means in how many hours they are supposed to complete the work, how many hours did they actually take to complete the work. It's only about hours, but we need a monetary value. So we multiply with the rate. So if I multiply with the actual rate, the efficiency has nothing to do with what rate you are paying them. So we only take the standard rate. Whether you pay them $10 per hour or $15 per hour, did they take more than the given time or less than the given time? That's all. We don't care about what you are paying them. That is HR responsibility. That is not the production department responsibility. If I'm talking about a manufacturing sector. All right. Even if I talk about a service sector, let's say a software employee. So a software employee was supposed to complete his work in 1 week. He did not complete in 1 week. So his team leader, his TL will only be looking at that. He will be saying that you are supposed to complete in 1 week. You did not. That's all. I don't care whether your salary is 1 lakh or 2 lakhs or 10,000. I don't care about it. So I have nothing to do with your rate to determine your efficiency. Are we all okay? Yes, no, something response, please. Are we all good? Wonderful. So now another excellent factor for us is overhead variances are same as labor variances. Overhead variances are same as labor variances. Nothing to change. Here, overhead rate variance, here, overhead efficiency variance. That's all. This overhead rate variance can be called as overhead spending variance. That's not a rate, that's spending, expenditure. Na? So we call it spending rather than rate. Just please make sure you write one important point. Variable overheads, I'll put a star mark here. You can write there either quantity or hours. It could be either H or Q. SQ into SR or SH into SR. AQ into AR or AH into AR. It could be either quantity or hours. Because overheads can be absorbed on the basis of either hours or on the basis of quantities. Acha. Yeah. All done? Can I continue? Or do you need any break or anything like that? Yeah, time kya? Oh, 11:30. Okay. Which department is responsible for overhead spending variance? Now, there is no particular department that would be responsible because usually it goes into production. Achha, I gave here HR. Okay, let me remove that. I say this. Overheads, may you have multiple overheads. Now, electricity bill is there. So, number of units, who will be responsible for that? Production department will be responsible for that. Rate, government will determine the rate. Right? So, most of the times you don't know who is the responsible person for spending variances. It depends on which overhead you are talking about. If it is packing, then production department would be responsible. If it is what do you say, transportation, then sales and marketing department might be responsible. You don't know which department you are talking about in case of overheads. Now, there are so many overheads to talk about. We would rather talk about the responsible person. Usually for accounts pending, let's say accounts maybe. Again, there is no standard. No. This is a mostly suitable one. That's all. There are different overheads. So for each overhead, it could be different story. Are we all clear with these things? Material, labor, and variable overheads. Awesome. Now comes the last one in the cost variances. What is the last one in the cost variances? Fixed overhead variances. Sir, the problem with fixed overheads is they are not like material, labor, and overheads, where you say, standard hours into standard rate, actual quantity into standard rate, something like that. Where fixed overheads are not like that, right? Fixed overheads are fixed for the total number of units. They are not changing on the per unit basis. So that's why we do not follow this regular approach for fixed overheads. We first classify the fixed overheads into two categories. Okay. So what are the two categories, sir? We categorize them into the same as overheads usually. Spending variances and efficiency variance. Sir, why do we do it like this? Just understand, what are we trying to do here? Fixed overhead differences between the budget and the actual we want to do. Let me rephrase that. Let me just move this and explain you in a better manner. Give me a second. All right. Sure. Sir, what are we trying to achieve with variance analysis? Usually variance analysis, we want to identify budget versus actual, correct? Yes or no? Budget versus actuals. That's what we are trying to achieve. So if I scroll to the top, what is the original objective of doing variance analysis? To calculate budgeted profit versus actual profit, budgeted profit and actual profit, right? So now the problem is we already segregated out the volume variance. Whatever difference you are getting because of increase in the volume or decrease in the volume, you separated that out. So here all the costs are taken on the basis of standard, not on the basis of budget. Static नहीं, standard के हिसाब से we are considering them. Are we okay with this or not? What I just said. Because static and flexible are here. So this is all about flexible only. Is that okay, or should I rephrase that again? Yes, no, kuch to bolo, repeat. Okay. See, your ultimate purpose of doing variance analysis is to calculate the budgeted profit and actual profit and the differences between that two, right? So when we say budgeted profit, which budget do we mean? Static budget or flexible budget? Sir, we mean static budget only. What were you planning to achieve? How much profit did you want to make at the beginning of the year versus how much profit did you actually make? I want to know that difference. That is static budget versus actual profit. I want to identify. But we already discussed why we should use flexible budgets and not the static budget, because static budget is for a given quantity, original quantity, budgeted quantity. Actual profit is for actual quantity. So I cannot compare apples with oranges. Sir, budgeted profit is for budgeted quantity, whereas actual profit is for actual quantity. How can I compare budgeted quantity and actual quantity? I cannot compare. That is why what we did, we introduced something in between called standard. Correct? That standard is the flexible budget that we prepared. Are we okay till there? Yes. Okay. So now what did we do? The difference between the static budget and flexible budget has been separated out into the sales volume variance. The difference between the static budget and flexible budget, matlab original budget and budget for actual. This difference we already segregated out. We kept it down into the sales volume variance. Usko alag karke chhod diya. So now all these costs are basically the difference between the standard, which is flexible. Flexible versus actual only we do for costs, correct? Because static versus flexible is into the sales volume variance. See, for you to easily understand, let me do something. यहाँ पे कर रहा हूं मैं. Sir, what was our original goal? Static profit. Profit as per static budget. Matlab original, what we thought. We wanted to compare this with actual profit. But the problem is, this is for budgeted quantity. This is for actual quantity. So I need something in between. Budget for actual. This is what this is called as standard. Or I also call this as flexible. Agree? So static budget versus flexible budget. This is covered in sales volume variance. Yes? No? Okay. Next, flexible versus actual. इन दोनों का difference is covered in all cost variances. Is that clear now? Yeah. Okay. Wonderful. So now you need to understand something, sir. There is one small problem with this explanation. That is fixed overheads. Sir, fixed overheads are not based on budgeted quantity, budget for actual or actual quantity. Fixed overheads are constant irrespective of the volume unless there are step fixed costs. So how do we differentiate in terms of fixed overheads? That is the only difference you need to understand. Now I assume you got the picture. Okay. So now when we come to fixed overheads, we need to do something here. We need to first understand that fixed overheads is how do I say this? Yeah, we are calculating standard versus actual. Usually, for all other costs, all the costs, we calculate standard and actual. But when we come to fixed overheads, we need to change this ideology. We need to compare standard versus budget versus actual, because this is not depending upon the quantity. Okay, standard versus budget versus actual karna hai. So now, originally total is standard versus actual only. Total, if I ask you what is the total fixed overheads, standard versus actual. But this is again split into standards versus budget, budget versus actual. Okay, so now efficiency variance. Why would there be efficiency? Efficiency would not be the correct word. Okay, I would rather call it volume variance. Volume variance would be a more appropriate word for that. Okay, so standard versus budget and budget versus actual. We have to split it into two. So budget versus actual is your spending variance. Whereas your volume variance is standard versus budget. So if you sum this two, what will happen, sir? Budget and budget will be gone. Standard versus actual will remain. Okay. We'll talk about it. Don't worry. I know it is slightly confusing. Do not worry yet. Abhi ke liye confuse mat hona. Just follow what I'm trying to give you here. Once we get into the numbers, you will get more clarity on the fixed overhead variances. Do not worry, sir. So how do I calculate spending variance? Spending variance is actual FOH, actual fixed overheads minus no, reverse होता है. Wait, just okay. Good. What difference does it make? I just want to be clear. Actual FOH minus budgeted FOH. And volume variance will be budget FOH minus standard FOH. Or you can reverse entire thing, no problem. We never said that if it is positive, if it is plus number, then favorable variance, if it is minus number, unfavorable variance. It's not like that, so it's okay. Or to avoid confusion, I can do like this. It doesn't make any difference what you are subtracting from what. End of the day, you should know what is favorable and what is unfavorable based on the values, not based on whether it is plus number hai to positive, negative number hai to adverse. Like that, you never learn it. All right, chalo. So now, okay, so let's try to navigate through this and understand what we are talking about. Sir, budget, we know. What is budget here? Originally, as per your static budget, whatever you have prepared, that is your budgeted fixed overheads. Actual fixed overheads means what? What we actually spent. Let's say our budget was FOH budget was $10,000 for 5,000 units. Pay attention. We wanted to produce 5,000 units. That was our static budget. Our budgeted fixed overheads was 10,000. Now, actual FOH is, let's say, 12,000. This is for, we'll make it, okay, 12,000 for, let me just check. I don't want decimals. Getting decimals. How do I say this? Okay, we'll take it 15,000 for 6,000 units. I don't want going on fractions, like continuing fractions. I don't want. So I just wanted to make sure proper numbers are taken. Okay, is this, are these two numbers clear for you all? Yes, no. Okay, so now understand this. What is our spending variance? How much you are supposed to spend versus how much you actually spent. Correct? Spending. How much you are supposed to spend versus how much you actually spent. So you were supposed to spend 10,000. You actually spent 15,000. So 5,000 adverse variance. Is that okay for everyone? Budgeted FOH was $10,000 minus actual FOH is $15,000. So $5,000 adverse we had. Adverse or unfavorable. Is that okay till there? You spent 5,000 extra. Okay. Now comes the problem, sir. Why, sir? Because 10,000 budget was for 5,000 units, 15,000 spent was for 6,000 units. So we need to calculate standard FOH. So standard FOH is what? Budget for actual. So what is your budget, ma? 10,000 for 5,000. So how much should be for 6,000? Calculate that. 10,000 for 5,000 means for 6,000 units, it would be $12,000, correct? Yes? No? Everybody got 12,000 or not, sir? Confirm in the chat. All of you got 12,000. All right. So your volume variance, what is the title here? Volume. Because of the increase or decrease, because of the difference in the volume, how much fixed overhead variance you are getting. Here we did not talk about actual quantity, standard quantity or anything like that. What was your budget? What is your actual? Here we are talking about the volume difference. Because of change in the volume, how much difference you are getting. So standard fixed overhead. So our standard is how much? We are supposed to spend 12,000 only for the actual quantity. Minus what was our budget? Budget was 10,000. That means 2,000 was due to what, sir? Was due to volume variance. Please copy this down till here. This just the numbers part. Are you done? Can I continue? All right. Chalo. Okay. So here you are getting favorable. Sir, why am I calling it favorable? As per your standard ke hisab se you are supposed to spend 12,000, but you thought that you will spend only 10,000. But that means your budget is already in a favorable manner for you. As per your actual calculations, just let me break it down for you even more easier. Your budget was 10,000 for 5,000 units. That means you are assuming $2 per unit, right? Agree? Now, For 6,000 units, 6,000 into 2, 12,000, we are supposed to create the budget. We can spend a maximum of 12,000 on the 6,000 units. But while preparing the budget, we told our employees that your budget is only 10,000. That means even though you can spend 12,000, you restricted the budget to only 10,000. Matlab already you have 2,000 on the favorable side. Does that make sense to you? Sir, imagine this like this. Then it will make even more easier for you to understand. You are going on a trip with your siblings. So your father told that, okay, I booked all the travel expenses. I booked all the hotel tickets and all that stuff. So you don't have any expenses other than your shopping and food. So for your shopping and food, I'm giving you this 30,000 rupees. Go and spend. You are the eldest sibling. So your father called you and gave you that 30,000 rupees. So you took that 30,000. You kept 5,000 inside your wallet. And you remaining 25,000, you went to your siblings and told them that, see, dad gave us 25,000 for our expenses. So this is our budget. So what you are doing there? You are already on the favorable side of 5,000. You kept that money aside for safety. So already you have a favorable budget there. So even if you overspend, even instead of 25,000, even if you spend 27,000, it's still okay. That 2,000 you can take away from that extra money that you kept aside. Does that make sense to you, Ma? Is that explanation clear? Yes? Wonderful. So here the same concept. Your standard requires you to create 12,000, but your actual budget was only for 10,000. Already you restricted the fixed overhead budget. So this is a favorable variance for you. Sir, standard says you can use maximum 10,000, but your budget said use 15,000. Already you are on the unfavorable side 5,000 in that case. Right? You told your employees spend 15,000, but you have only 10,000 in your budget. Gaya fair. That is the unfavorable scenario. Here, you had a standard of 12, but your budget is telling only spend 10,000, which is favorable for you. So यहाँ पे total देखो क्या हो गया? 5,000 adverse, 2,000 favorable. 5,000 minus 2,000 plus. So 3,000 adverse is your net fixed overhead expenditure. Sorry, fixed overhead variance is 3,000 adverse. Sir, how do we calculate variances? Standard versus actual. Standard is how much? Standard is 12,000. Standard is 12,000. Actual, how much you spent? 15,000 you spent. So 12,000 you are supposed to spend. You spent 15,000. That means total variance is how much? 3,000 adverse. Isn't that what you got here? 3,000 adverse. We are just breaking that to two pieces to understand how much of that is because of volume, how much of that is because of too much spending. You overspent 5,000, but out of that overspent 5,000, 2,000 was because of increase in the volume. Remaining 3,000 was actually overspent. That is what we are trying to explain here. Is that understood, sir? $12,000 is for 6,000 and 10,000 is for how are we booking favorable variance upfront. That is what this favorable variance includes this adverse variance. That's what I was next about to tell. So spending variance is for total. Okay. Spending variance is the total. It includes volume variance. Is that okay? Shreya, your doubt is 100% legit. You are absolutely on the right track. You are perfectly analyzing the scenario. So let me come down here. Understand this. Simple. You had a budget. In the budget, you said fixed overheads is 10,000. But that budget you prepared assuming 5,000 units. But actually you produced 6,000 units. That means your standard should have been 12,000. Right? Now you are saying that budget was 10,000, we spent 15,000, 5,000 overspend ho gaya, which is adverse. Okay, that is calculation part. But out of this 5,000 overspent, entire 5,000 is not because of the fixed overhead problem management or something like that. 2,000 was because you increased the number of units. Instead of 5,000, you produced 6,000. So $2,000 was because of number of units increased. 5,000 total spending difference. You are supposed to spend 10, you spent 15, 5,000 extra you spent. Out of this 5,000 extra, 2,000 was because of increase in the number of units. Remaining 3,000 is because of improper management or improper planning. That is the actual adverse variance. That is why net variance is only 3,000. This 5,000 adverse includes the 2,000 favorable. That's why we say net is 3,000 adverse. Shreya, you understood your logic or not? But why did we include it? That might be the next question. Sir, why shouldn't we separate it? Because here we are separating them out now like this. Happily, we separated out everything. Why didn't we do that for fixed? That is the problem. Fixed overheads does not depend on the quantity. Fixed overheads is fixed for the number of units. So these are mathematical changes that we are doing. And this entire nonsense only comes when you talk about, just for your information, if you did not figure it out already, you should have figured it out. But if you haven't, so let me tell you, the concept of standard only comes from applied or absorbed overheads. If you do your absorption costing or ABC costing, what do we do, sir? Absorbed on the basis of labor hours, absorbed on the basis of machine hours, absorbed on the basis of cost drivers. That absorbed value is called as the standard fixed overheads. You can take a note of this now. We are done with the fixed overhead variances. All done? Okay. So let me just share one file with you all. Just a problem. Desktop variance. Please confirm if you all got that problem or not. PDF file. Okay. Chalo. So let's solve this problem to get a better understanding about what all did we do till now. Okay. See what is happening here. We have a cost variances comprehensive problem. So let's start with this. Since most of you asked for numericals, I'm doing this now. So Smart Manufacturing Company produced 5,000 units of product during the period. Standard costs are direct material per unit is 2 LBS. LBS means pounds. Okay. LBS is equal to pounds. Like we measure our quantity in terms of kilograms. In UK, they measure it in terms of pounds. At $1.60 per pound. Similarly, direct labor, each unit will take 3 hours at 2.5 per hour. Direct labor, variable overheads per direct labor. Matlab variable overheads are absorbed on the basis of labor hours, not variable overheads, but calculated on the basis of labor hours. $1.5 per labor hour. Fixed overheads per direct labor hour is 0.5. Sir, will fixed overheads be calculated per unit or total? Fixed overhead should be calculated per unit or fixed overhead should be calculated in total? Fixed overheads hamesha we calculate total, right? Very good. So let's calculate the total first of all. They already told you normal capacity is 16,000 labor hours. Each labor hour they gave 0.50. So 16,000 into 0.50. That will be how much? $8,000 is your fixed overheads, right? Agree or not, sir? Confirm in the chat section if you agree that budgeted fixed overheads are $8,000. Agree? Yes? Only 5, 7. Only 7 people. What happened to remaining 20 to 23 people? Agree? Okay, cool. Chalo. So budgeted fixed overheads is $8,000. So this was our budget, sir. Very good. Now let's see the actual numbers now. Actually, we purchased 10,100 pounds at 1.65 per pound. 9,500 pounds are used in the production. Sir, should we take the total purchased or should we take the units that are actually used in the production? Should we take the purchased 10,100 or should we take actually used 9,500? We only take 9,500 that are actually used in the production. Sir, why? You tell me. I don't know. You tell me. That was the question. No answers. Three answers were there, and all the three say used we have to take. All right, sir, here comes a small difference which we did not discuss in the calculation. Very good. Afsana says purchased should be taken for price variance because it shows how efficiently product. Oh, sorry, I'm reading two different answers. Okay. Cost is calculated on the used variance, correct only. Shreya says because it shows how efficiently production department used from total available. Okay, so used should be taken. Very good. So here, actually in this question, you have two material variances, right? So in material variance, you have purchase variance, or sorry, you have a rate variance, and you have usage variance. So in rate variance, you have to split it into two more. One is production and the other one is inventory. For production, we take 9,500. For inventory, we take remaining 600 pounds. Does that make sense to you? Why did I use the word inventory here? You purchased 10,100. You used only 9,500. That means remaining 600 are in the closing stock. All of you once confirm if you understood this numbers explanation or not. Yeah? All right. Very good. Chalo. So for usage, we take 9,500. For rate variance, we take total 10,100. Out of that, 9,500 is in production, 600 is in inventory. Okay. Chalo. Next. Actual direct labor hour 15,400 at 2.6 per hour. Then actual overheads 22,800 variable, fixed 8,100. So these are the informations that are given to us. So let's start our problem with material variances. Shall we? Okay. So let's first start with material variance. So how do I calculate material variance, sir? Oh. How do we calculate material variance? We calculate it as actual material cost minus standard material cost, correct? That is what we do. Okay, what is actual material cost? How much did you buy? You purchased 10,100 at 1.65, right? How did you go into the center suddenly? What is the actual material cost, ma? Actual material cost. You purchased how many? 10,100 units. You purchased at what rate? At 1.65, correct? So what is this total? You calculate and tell me. You guys should be faster than me. 10,100 into 1.65, that is 16,665. 16,665 we spent. What is the standard material cost? How much material are you supposed to use? Sir, standard कैसे आता है? Supposed to use. Each unit per finished unit, you are supposed to use 2 lbs. 2 pounds you are supposed to use per finished unit. So how many units we finished in the period? How many units did we produce? 5,000 units of product. Smart manufacturing produced 5,000 units of product. So standard material would be 5,000 units produced into 2 pounds per unit into what is the standard rate? You are supposed to purchase at 1.6 per pound. 1.6. So this will be 5,000 into 2 into 1.6. 16,000. So this is showing that what is the variance here? Favorable or unfavorable? You spent 16,000, whereas you are supposed to spend only, you spent 16,665, whereas you are supposed to spend 16,000. So that means $665 unfavorable variance it is showing, right? All of you are clear till here? 665 unfavorable. Yes. Okay. So let's go on. Now let's try to split this into bits and pieces, sir. So what are the two variances you have, ma? Material rate variance and material usage variance. So how do I get the material rate variance? Standard rate minus actual rate into actual quantity purchased लेना है यहाँ पे, and usage variance standard quantity minus actual quantity into standard rate I have to take here. So how do I get the rate variance? Material rate variance. Standard rate was how much? 1.6 minus actual rate is 1.1615. 1.65. Okay. 1.65 into actual quantity purchased. Total purchased is how much? 10,100 units. So this is how much? 1.6 minus 1.65. Minus 1.65 minus 0.05 into 10,100. That is 505 unfavorable. 505 unfavorable. Is that clear for all? Very good. All of you got minus 105, which is very good, guys. Nice. Now, material usage variance. What is standard quantity? You are supposed to use how much? 5,000 into 2. You are supposed to use 10,000 units. Actually, we used 9,000. Actually used in production 9,500 lbs. Okay. 9,500 pounds into standard rate is 1.6. So 500 into 1.6. 800 favorable. All of you got this or any doubts, sir? Very good. So now do the total, sir. 800 favorable minus 505 unfavorable. 295 we should get. Correct? Total material variances should be rate variance and usage variance. In दोनों का total करो. How much you are getting? 295 favorable you are getting. But what was the total, sir? Initially we got how much? 665 unfavorable, sir. क्या हो रहा है, sir, यहाँ पे? Means my answer is wrong. Right? Is our answer wrong or correct, sir? Did we do any mistake anywhere? Take your own time and find out if we did any mistake anywhere. Totals are not matching. क्यों? Anybody? Any answer? Because we have two values, purchased and used, correct? So what is the difference? Let me tell you. Sir, inventory कितना है? How many units do we have in inventory? We purchased how many? 10,100. We used how many? 9,500. So 600 units we have in inventory. 600 LBS, correct? All right. Multiply this with the standard rate. What is the standard rate? 1.6. Correct? So multiply and tell me the value. 600 into 1.6. 960. Okay. Now, how do I explain this to you without confusing you further? Did you buy at 1.6 or did you buy at 1.65? Is your rate variance favorable or unfavorable? Tell me that. That answer would be more easier for you. Is your rate variance favorable or unfavorable? Unfavorable, right? So because of inventory, what will happen, sir? Your value increases. Your storage value or your cost, your price increased. So this is basically an unfavorable variance. So now you sum this two up. 295 favorable, 960 unfavorable. दोनों को ऐड कर दो. Oi, idiots. HN, Tulasi, pure idiots. You are adding up favorable number and unfavorable number. Plus to minus, check your plus and minus. 665, right? Favorable or unfavorable? 665. 960 unfavorable, 295 favorable. So 665 unfavorable. Now go back and check your total, sir. Original total. 665 unfavorable. Is that okay, sir? This is an exceptional case. These kind of cases won't be there in your exam. Don't worry. These are exceptional cases. I wanted to cover different scenario in the class. So that's why I changed this. So I assume this is clear for you. Basically, this 505 unfavorable includes inventory portion also. That's why we had to calculate the standard rate of that and separate it out. Then you will get the correct answer. मतलब logical explanation utna in depth जाने की जरूरत नहीं. You don't need to worry about that much depth of the concept. You just understand that there is some inventory left because of which your total is not matching here. That is what I want you to appreciate. All right. So we got the material variances, right? 505 unfavorable and 800 favorable. So 295 favorable is what we got. We'll keep that aside. Next, let's talk about labor variances. So how do we get labor variance? Standard hours into standard rate minus actual hours into actual rate. What is standard hours for labor? Labor standard hours. Direct labor per finished unit. 3 hours at 2.5. 3 hours at 2.5. 5,000 units into 3 hours into 2.5. 5,000 units into 3 hours into 2.5. This is the standard. minus actual. How much is our actual labor? 15,400 hours into 2.6 per hour. 15,400 at 2.6 per hour, right? What is the actual? Calculate the variance here. 15,000 into 2.5 is 37,500 minus 15,400 into 2.6, 40,040. What is this? Unfavorable, huh? Yo, are you guys calculating or am I doing the problems for myself? $2,540 unfavorable. All of you got this? 2,540 unfavorable labor variance. Now let's break this into bits, sir. What are the two labor variances? Labor rate variance, labor efficiency variance. Rate variance is what? SH minus AH into AR. Efficiency is, oh sorry, wait. Rate variance. SR minus AR into AH, and efficiency variance is SH minus AH into SR. Sir, I'm just thinking the logic inside my brain. That's all. That's why the formula takes a little bit couple of seconds to answer. That's how it should be. You should always understand the logic to derive the formula. So SR minus AR, standard rate is 2.5 minus actual rate 2.6 into actual hours 15,400. So that is 2.5 minus 2.6 into 15,400 minus 1540 unfavorable. Okay. Then what about efficiency? SH standard hours 15,000 minus 15,400 into standard rate. Standard rate kitna hai? 1.6. Sorry, 2.6. 0.5 or 2.6? Standard rate 2.5. Okay. Minus 400. 15,000 minus 15,400 into 2.5. Minus 1,000. Unfavorable. Sir, 1540 minus 1540 minus 1,000. Minus 2,540. Unfavorable. Are we okay with this or not? Very good. Next. Next क्या है? Third. Variable overhead variances. So same as labor variances, right? So let's go back to the question to see whether we get the quantities or hours here. So the question was entirely dependent upon 5,000 units of production, and also they told you variable overheads per direct labor hour are 1.5. Variable overheads per direct labor hour are 1.5 per labor hour. But labor hours, how did we get? Depending on the production, 5,000 units into 3 hours. All okay? Okay, we can. So variable overheads is standard hours into standard rate minus actual hours into actual rate. I'll have to take standard hours for variable overheads. What is the standard hours? 3 hours per unit. 5,000 units product produced. 3 into 5,000 into 2.5. Oh, sorry, 1.5. Yeah. Variable overheads is 1.5. So 5,000 into 3 into 1.5. Actual hours. 15,400. Oh, directly we got the actual variable overheads 22,800. Okay. Sir, we don't know the rate here. 22,800 is directly given. You all see that 22,800 is directly given, ma. So first calculate AR. AR is equal to 22,800 divided by AH. Actual hours are how much? AH actual hours 15,400. So divide by 15,400. So actual hours, actual rate is 22,800 divided by 15,400. That is you 1.48. Some decimals are there. I'll keep it as it. Are we okay? Can I continue? Okay, very good. Chalo. So now our variable overheads is how much variance? 5,000 into 3 into 1.5, that is 22,500 minus 22,800, that is minus 300 unfavorable we have. Minus 300 unfavorable. Let's split that into two. What are those? Variable overhead. Spending variance and variable overheads. Efficiency variance. How do you get variable overhead spending variance, sir? Actual hours into actual rate minus to standard rate. This only basically you write it as a let me rephrase that. SR into AH minus AR into AH. Right? So standard rate kitna hai? Standard rate is 1.5. Or directly you do it here. Why all this nonsense? Directly you do. Standard rate is 1.5. Actual rate is 1.48. Actual hours is 15,400. So this is how much? $15,400 into 0.02. 308. 308. Okay. Favorable or unfavorable? Favorable. Actually, if you see here, this is 1.48. How much was that? 22,800 by 15,400 was 1.480519, something like that. So this will be approximately 300 rounded off. Is that okay for everyone, or do I need to explain you why 300? If still you have doubt, you can understand this. Yeah, SR into AH minus AR into AH. SR is 1.5. into actual hours is 15,400. AR into AH is actual. Actual is already given 22,800. So 15,400 into 1.5. 23. What? What am I getting here? Fifteen four hundred into 1.5. 23,100 minus 22,800. 23,100. I was looking at it as 22,100. Sorry, I was thinking 700 ka difference. Okay, so this is 300 favorable. Same thing. Okay. All right. Okay. Chalo. So this is about your variable overhead spending. Then variable overhead efficiency. Efficiency. How many hours you are supposed to spend? Standard hours minus how many hours you actually spent. Actual hours into standard rate. So standard hours is 15,000. Actual hours is 15,400 into standard rate is 1.5. So 400 into 1.5. 600. Favorable. Sir, why unfavorable? You spent more hours. You are supposed to spend only 15,000 hours, but you actually spent 15,400 hours. So we overspent, so unfavorable variance. So total kitna hoga? 300 favorable, 600 unfavorable. Total 300 unfavorable. Are we okay with this or still any doubts to anyone? Next. All right. Next, after that, we have fixed overhead variances. Last one. Fixed overhead variances. So how do we calculate fixed overhead, sir? Standard minus actual. Standard is nothing but applied overheads or absorbed overheads, right? So fixed overheads is again segregated into two parts. What are those? Spending and volume. Spending is budget versus actual. Volume is standard versus budget. So budgeted fixed overheads. Total fixed overheads budgeted was 8,000. Actual fixed overheads 8,100. So $100 unfavorable. You spent 100 extra, right? All able to follow? Fixed overheads. Fixed overhead spending 100 unfavorable because we were budgeting for 8,000. We spent 8,100. So 100 extra spent. That is your spending variance. Now let's calculate the standard, sir. How do we calculate standard? They told you per labor hour, per direct labor hour 0.50. Per direct labor hour 0.50, right? What was the direct labor hour standard? 5,000 units of production and 3 hours per unit. 5,000 units, 3 hours per unit, 0.5 for each unit, each hour. So how much would that be? 5,000 into 3 into 0.5, 7,500. So standard fixed overheads is applied is equal to 5,000 into 3 hours into 0.5, that is $7,500. So standard is 7,500, budget was 8,000. That means unfavorable 500 you have. So total 100 unfavorable, 500 unfavorable. So total 600 unfavorable minus 600. That is standard is 7,500. Actually, you spent 8,100. Yes. Anybody had any doubt? Sir, why do I see Q&A being very nil? Nobody had any questions, huh? No. Either it means I have been very clear with the explanation, or it means nobody are paying attention. No questions only. Very good. Okay. Chalo, then I'm continuing. So what are the total, all the variances, all the cost variances are clear for you? All right. So we are done with all the cost variances, except mixed variances are there, which are later on. We will not be able to do that now. Even if we do also, everything will be confusing. So I'll stop there. And do you want to do the sales variances now, or I guess we still have about 25 minutes left for the scheduled time. So you guys tell me, Mark, shall we continue to sales variances, or do you want to stop now? I'm expecting more answers, only 2, 3. वाह भाई सर, पूरा रामायण सुनने के बाद यू आर आस्किंग व्हाई डिड राम मैरी सीता? What is the actual purpose of making a standard budget when we have the actuals? Better to identify the variances and to find out what is responsibility, who is the responsible person, where we are lacking, what did we do right, what did we do wrong. वो सब समझने के लिए we need to compare ना. How can you compare standards with budget when the quantities are different? You cannot. That is why you have to do it. Chalo, we'll continue with the sales variances. Only the primary two variances. Ma remaining variances I'll not be able to cover now. The what do you call them? Mix and yield variances and all that stuff we'll not be doing now. We'll only stick to the basic two sales variances. Okay. Can you zoom out the page once? Okay. Still, this is the total page. All right. Chalo. Oh yeah. All right. So the last part for today's discussion would be sales variances. So sales variance, basically, if I just give you an overview, okay. So how do we calculate sales variance, sir? Budgeted sales minus actual sales. Concept, just the pure concept. Now, do not go into the formulas yet. Budgeted sales minus actual sales, that should give you the variances. But when you come to sales, we have to reverse that out. Actual sales minus budgeted sales. Q, sir, because if actual sales is more than budgeted, you have favorable scenario. If actual sales is more than budgeted, it is favorable for you. So let's put actual sales minus budgeted. In expenses, we put budget minus actual because that would be favorable there. Just for you to easily understand plus and minus numbers, that's all. So actual sales minus budgeted sales. How do I get actual sales? Actual quantity into actual price. How do I get budgeted sales? Budgeted quantity into budgeted sales, right? Yes or no? All right. So this, if we split it into two parts, we get sales volume variance and sales price variance. Sir, what is sales volume variance? This is nothing but, okay, what is it called? That is also the static versus flexible. So sales volume variance is actual quantity minus budgeted quantity into standard rate. And price variance would be actual price minus budgeted price into actual quantity. Now comes the question mark. When you talk about sales, budgets and standards are usually the same thing. Budgeted price and standard price means the same. Okay. Should I repeat again? Budgeted price and standard price are same. They are not two different things. Whatever your budgeted price, that is only called a standard price. So no, there is no difference between these two. Please note down till here. Done. Yes. All right. So these are your sales variances. Now within this sales volume variance, again, we will split this into quantity variance and mix variance. These things, mix and quantity, mix and all that stuff, I want to discuss later. Okay. This session will not be, we should not be covering that because those are advanced variances, which is out of the basic variances concept. So these are your basic variances. Advanced variances, we'll do it as a separate session. All right. So let me know if you have any doubts anywhere till now. You go ahead. I'm just trying to merge everything into one page so that. Let me know if you guys have any doubts. Quick. Please don't exit. I'll give the PDF here. I don't want to mail you the PDF files again. So just stay back. Let me give you the PDF. Then you can leave. All right. If you do not have any doubts, then we'll wind up the session. All right. Please check, all of you. I guess you should be able to see the PDF file. All of you are able to see the PDF file? Confirm. All right then. Okay, so I do not have any open questions, and let me confirm the chat also. All right, everybody got it. So let's wind up the session. Enjoy your rest of the day. We'll plan for the next session soon. Bye-bye.